Hi there, in this Tutor Tube business economics video, let's spend a few minutes thinking about demergers. Now, a demerger happens when a business decides to split into separate divisions, separate firms. So a company might spin off one or more of its subsidiaries or business units as separate entities. Good example back in 2021, where Johnson & Johnson, a major multinational pharmaceutical company, consumer goods manufacturer, they announced a demerger involving their orthopedic business. So they wanted to spin off that side of the business, includes joint replacement products, as a separate stock market traded company. So demergers is the separation of existing businesses into independent companies. Well, what drives demergers? What are the key motivations? Essentially, I think it's all about focusing on core business to try to reduce unit costs. So the idea here is that if you rationalize or streamline the business, offload perhaps some underperforming businesses, that in theory helps improve profit margins, should lift the share price, and increases the return to shareholders, the owners of equity. You could also make a nice link between demergers and the risk of diseconomies of scale. See, often businesses may expand beyond their optimum size, leading to an increase in long-run average cost due to decreasing returns to scale. The business may become too large, too complex, too costly to manage, and therefore demergers is a way of trying to eliminate or lower the risk of diseconomies of scale. So really quite important to link those two concepts together. Demergers may involve selling off parts of a business. Now, the money from the asset sales could be returned to shareholders via a share buyback. Again, that can lift the share price for investors. Synergy dissolution. Well, many mergers and takeovers don't bring the commercial synergies, the commercial benefits that were anticipated and expected. So many mergers fail palpably to do that. So demerging is often a response to businesses deciding it hasn't worked. Integration has led to underperforming assets. The business needs to be streamlined to enhance financial performance. And finally, demergers might be a defensive tactic in game theory terms to avoid the attention of a country's competition authorities who might be investigating monopoly power. So, spin-offs, divestitures, separation of companies, demergers. And of course, the key is to think about the consequences for different stakeholders, employees, customers, and other stakeholders. Well, on employees, of course, there can be some downsides. First of all, job uncertainty. So employees may experience uncertainty about their job security, their role, their responsibility. Will I still have a job in 6 months' time? Indeed, some positions might be duplicated or no longer needed in the new entities, leading to potential layoffs. Compensation packages, the salary, the bonus, the benefits may be different in an entity, a subsidiary that's been spun off. But equally, they can create opportunities for employees to take on new roles, new skills. Newly independent companies often have a new lease of life, a new energy about them, having been sold off. What about customers? Well, potentially there's disruption for customers in terms of the demerger process. So as systems operations are divided, there might be some delays or changes in the quality of service. On the other hand, demergers can lead to increased competition. So, for example, if you engage in a demerger in the telecom sector, for example, that creates a new entity that might generate more competition, leading to lower prices and improved quality of service. Equally, there could be some contractual changes. If you've got a contract with a demerged entity, the terms and conditions of those contracts might be affected. So consumers may face changing contracts, changing tariffs, and so on and so forth. Now, for shareholders, the key really is what happens to the commercial and financial performance of the firm. So following a demerger, the stock price may experience changes as the market adjusts to new entities. The dividend policies may be different from the original company. And shareholders who hold shares in diversified companies may have shares now in multiple companies, leading to better diversification. And it may well be the case going forward that a demerged business has a clearer strategic focus. They've got rid of some of the diseconomies of scale, and therefore that allows people to change their portfolios with companies that match their investment preferences and risk tolerance. So overall, demerger is quite interesting There's a lot of economics about horizontal and vertical integration, lateral integration, the growth of businesses. But it's worth being aware that there are lots of demergers in the business world, often, I think, the result of palpably failed mergers and takeovers. So this is definitely worth revising ahead of the exams. Take care. See you soon.